Hey there, it's Linda Hayes. Have you been struggling creating a statement of comprehensive income or understanding what goes into that versus the other comprehensive income? That's what we're going to talk about in this video, as well as go through some examples. The first thing I want to say is this is not a full review of everything you'll find in the textbook about the income statement and statement of comprehensive income, but we're going to do enough that you can try to prepare one without too much trouble. So what is comprehensive income? Well, it's basically everything that changes for owner's equity except transactions with owners as the capacity as an owner. For example, if dividends are paid out, that's not an expense because it's a transaction with the owner. So it's going to be going through the statement, it goes through the retained earnings account, which is the statement of shareholders' equity. Now, for the comprehensive income, you can do one statement called the statement of comprehensive income. And if you did that, you would have your net income, and then you would have other comprehensive income items right underneath, and the two of those together would be your comprehensive income. Some people have tons of items in OCI, other comprehensive income, and as a result, they'll do two separate statements. The first one being their periodic profit and loss, which is sometimes called the income statement, statement of operations, statement of earnings, many different titles you can use. And then the second one being your other comprehensive income, which of course you start with your net income and then add all your OCI items to get your total comprehensive income. So what goes into other comprehensive income? Well, it includes unrealized gains and losses. So when we have an investment, for example, certain investments are going to be fair valued on our statement of financial position. But if we didn't actually sell it, we do not want those changes going into net income until the investment is actually sold. So we call that an unrealized gain or loss. Basically, we bought an investment for $100, it's now $120, there's a $20 gain, but we're not going to make that as a gain unless we were actually to sell it. So the OCI is a temporary holding category for things like that. So that's one of the things, unrealized gains and losses. The second item is foreign currency gains and losses on consolidating subsidiary statements. So if you have a parent company that owns other companies called subsidiaries, you'll have foreign currency gains if the company is in another country. So those things will also go into OCI. And lastly, we have net actuarial gains and losses related to pension plans. In the next intermediate accounting class, you'll go through more about pension accounting. So for now, you just need to know that these things actually go into OCI versus the income statement. So there's two ways you're allowed under IFRS to prepare your income statement. And the first one here is an example of the general presentation by nature. And what that means is that the expenses are based on the input costs. What did you spend the money on? So for Air Canada, you can see they spent money on aircraft fuel, wages, regional airlines expenses, etc. So that's the example of one of the methods you can use. So the other method you can use is general presentation by function. And so that's an output-based measure. So you're actually looking at what the expense was used for rather than what it was spent on. So in this case, they use some of the expenses for selling goods. So they have cost of goods sold. They have selling and expense. And there's a note 16 that has more detail on what that selling and administration expenses were. So basically a completely different format you do if you're doing it by function versus by nature. And both are allowed under IFRS. The next topic I want to talk about is non-controlling interest, which is abbreviated NCI. And this arises if you have a parent company that owns a subsidiary, but they don't own 100% of it. So I was already talking about consolidated statements. When I looked at the last example, it said consolidated statement of net income. I think it was the Air Canada one that said that. And basically what that means is Air Canada has many different companies that they own. And when you looked at the consolidated Air Canada statements, all of those companies are added together. Now, what they do is they would basically take everything together in the consolidated income statement, and the net income would include all the revenue and expenses of the parent and the sub, which means they're bringing in 100%. But of course they don't own 100%. So what they do is they take that 100% and they proportionally allocate it to the controlling interest. So as an example, if we had a subsidiary where the parent owns 75% of it, the NCI, the non-controlling interest portion, has to be the other 25%. The next thing I want to talk about is earnings per share. And the formula is net income minus preferred dividends. And we take out preferred dividends because we want to have the earnings that's available to common shareholders. So net income less preferred dividends, and we divide that by the weighted average number of shares. Okay, so when do we have to disclose earnings per share? Well, for public companies, they need to disclose two things. One is the basic earnings per share, and the other is the diluted. They also have to disclose the weighted average number of shares. And the way you calculate weighted average is a little different than a simple average. For example, if I had 100,000 shares issued at January 1st, and then at December 31st I had 200,000, my simple average would be 150,000, right? That's easy. That's not what we have to do for this calculation, because if the extra 100,000 shares were issued throughout the year, we have to weight that for the time they were outstanding. Just as a simple example, if you had issued the 100,000 shares April 1st, you would have had 3 months with 100,000 shares, 9 months with 200. So the way you do the math is pretty simple in this case. As long as it's a full month, you would take 3 out of 12 times the 100,000. You would take 9 out of 12 times the 200, add those together, and that would give you your weighted average number of shares. The other thing you have to do is a calculation for fully diluted earnings per share. Now this basically shows how earnings per share would change if all common shares promised under existing agreements were exercised. So things like option agreements, if the company has bonds or preferred shares where they're able to convert them into common shares, that would change the weighted average number of shares. If a bond was converted, not only would it change the number of common shares because more are issued, but you would also save interest expense on the bond. So you'd have to change your net income, and if it was a preferred share that was exercised, you would have to get rid of some preferred dividends potentially, along with changing your weighted average. So these diluted earnings per share calculations are a little bit more complex. Now I want to look at some examples. So Maple Leaf Foods here from the textbook has their consolidated statement of net earnings. And I wanted to show this one because it has earnings per share. So you can see the basic and diluted calculations here. Now in 2019, you can see that the calculation for basic and diluted is the same. And a lot of times that's because it rounds to be the same, or in some cases it's because there were no items that caused dilution at all. But you can see for 2018, Maple Leaf Foods definitely had a difference. It was 81 cents per share for basic. And then if everything had been converted or options exercised, they would have had 79 cents per common share. Okay. The other thing they're disclosing here is the weighted average number of shares. So you could see the different numbers here, where if everything was exercised or converted, we'll obviously have more shares than we do right now. You may also see in certain income statements a category called discontinued operations. And this is basically where a company takes one of their operating segments and sells it, or it's held for sale. Now, held for sale means I have a segment that I want to sell, and to do a held for sale classification, there's specific criteria that needs to be met. So to qualify, basically you have to have an asset group that has to be a cash generating unit, which is called a CGU, and it has to be a major line of business or a significant geographic segment. And it has to be a part of the business that has independent cash flows. And for held for sale, when I said it needs to meet criteria, that's something we'll go through in a later chapter. For now, just know that for held for sale, there's different things that happen. So one thing that happens is your amortization of your asset would stop. So if you have depreciation or amortization on any of the assets in that operating segment, instead of doing the depreciation or the amortization, you would take your assets and remeasure them to the net recoverable amount. So how much are you going to get when you sell it, basically? And then the assets that are held for sale means you have to keep remeasuring them every period until you sell them. And gains and losses on discontinued operations are reported separately, net of tax, after income from continuing operations. So a normal income statement ends with net income, right? So you have your income and you have your income tax, and then you have net income. But if you had a discontinued operation, you would have a couple lines at the bottom. And because you already showed income tax above, if you had income from a discontinued operation, you would report that income less the income tax in that below section called discontinued operation. And if you actually sold that operating segment, you also would have a gain or loss from sale. So here is an example where this company, Thomas Reuters, does have a section called continuing operations because they also have this loss from discontinued operations net of tax. Now, a lot of companies will show the amount of tax deducted right in the right in the income statement here, but in this case they have note number 11, and that's where they'll have the breakdown. Now, what else do you have for discontinued operations? Well, basically, obviously you started with the earnings from continuing operations. Then you take away the loss or the earnings from discontinued net of tax. But what do you also do? Well, if you look in the earnings per share, obviously there's a lot more disclosure here because the basic earnings per share, we had to break it down into the continuing operations and the discontinued operations separately, and then we had to do the same thing for the diluted earnings per share. So as soon as you have discontinued operations, there is a lot more things that you're going to see on the statement, the income statement. Now, I took a couple of slides directly from the textbook slides. Again, I'm not going through all of the slides because there's way more than what we're covering here, but these ones are kind of important because in Canada, we use IFRS for public companies or publicly accountable enterprises, but we also use ASPE for most private enterprises. So what are some of the primary differences? Again, I'm not going to read every word on these slides, but for ASPE, for example, there is no specific format for expenses. So under IFRS, we said you could do expenses based on nature or function. Under ASPE, they don't really have a specific format. But ASPE does have more required line items that's either presented on the face of the statement or the notes, where in the case of IFRS, there's a lot more judgment. For the statement of comprehensive income, IFRS obviously has OCI, which we were talking about already, but under ASPE, the concept of OCI does not exist. So gains or losses would be reported either in net income or as a separate component of shareholders' equity. So no OCI at all. Another thing that's different about IFRS is it requires, we said, basic and diluted earnings per share to be presented. Of course, ASPE didn't. Another thing about ASPE is that it requires assets held for sale to be classified as either current or non-current, depending on their nature. The next topic is restructuring or provisions. So IFRS has specific guidance on constructive obligations relating to recognition of restructuring, where ASPE does not. Now, what is constructive obligation? I like to use that as an example. When we have a liability, typically it's because we have a legal obligation to pay something. Constructive obligation is where we have an expectation that something's going to happen, not a legal one. So oftentimes under IFRS, you might be recording things more so than what you would be doing under ASPE.